Hello, my name is Max Rappa.mp4, and today I'm going to talk about the financial crisis in the Republic of Cyprus, how it affects the American financial markets, and how it affects general investor confidence going forward. Before I begin discussing the crisis, I'm going to start with a little background information on the country. Prior to the crisis hitting, and before the country became the constant subject of international financial news, Cyprus was a barely mentioned island nation located in the Mediterranean Sea. Up until 1960, Cyprus operated as a British colony. Following Britain's departure, violence broke out between the two main nationalistic factions, those who were of Greek origin and those who were of Turkish origin. The non-stop battle for control of the island continued until a war broke out between Greece and Turkey that resulted in a split of the island in the year 1984. The northeastern section of the island became the Turkish Cypriot, and the other half of the island became the Republic of Cyprus, which is officially recognized by the UN. The population of Cyprus is about 1.5 million people, with 77% of its population being of Greek origin, and about 18% of the population originally from Turkey. The economy of the Republic of Cyprus relies on mainly two industries: tourism and the financial services sector. Due to its fairly relaxed tax laws relative to its neighboring countries, Cyprus has built up a reputation as an offshore tax haven for wealthy individuals and companies looking to save money. This, in turn, has allowed the banking industry to amass a value that is an estimated 5 times larger than the economy of the whole country. The largest nationality of depositors are Russian, who account for a third of the $88 billion in total deposits. In terms of how the economy of Cyprus ranks with all the other Eurozone countries, it is number 15 out of the 17 countries in terms of GDP. If you combine all the total GDP of all Eurozone countries, Cyprus would only account for a minuscule 0.2%. This number is slightly larger than the share of the total GDP of Malta and Estonia. The Cyprus crisis got rolling when global domino effects, stemming from the United States subprime mortgage crisis in 2007 and 2008, caused the nation to enter into a slight recession. This recession caused unemployment to rise, which then in turn caused unemployment benefits to increase. This started to create more and more debt for the government. The crisis began to take full effect when Greece found itself in incredible debt in the summer of 2012. Requiring it to need a very large-scale bailout plan in order to avoid a complete default. A couple measures were taken in order to ease the Greek debt. The first measure is known as a debt haircut, which cut a percentage of the total debt Greece owned to its bondholders. Effectively, this meant that for every dollar you invested in a Greek bond, you were only going to get a certain percentage of that dollar back. In the most extreme cases, some investors only recouped 26 cents off every dollar they invested. The other measure was the Greek bond interest rate. It was cut in half to 3.5%. This meant that investors were now receiving half of the yield. Cyprus was really exposed to the Greek financial crisis because of the Cyprus banks. In order to attract more depositors, the banks offered very high interest rates in the neighborhood of 4.5% to potential depositors. In order to be able to pay off their depositors at that high interest rate, they needed to invest in an asset with an even higher interest rate, such as Greek bonds. When the interest rate on Greek bonds fell to 3.5%, the Cyprus banks owed more to depositors than they were currently getting back in returns, which in turn ran them into extreme debt. Yesterday, on March 25th, Cyprus and the Troika reached a unique bailout agreement. For the first time in history, depositors' money was used to recapitalize bank funds. Depositors with accounts with money over $130,000 were charged a 40% fee on their accounts. Also, in order to stabilize the country, capital controls were imposed to control the outflow and inflow of money. The impact of this deal is far-reaching and has many implications for the future. Initially, upon news of the bailout, U.S. stocks received a small boost with the thought that the European Union was stabilizing. This rise lasted a brief moment when the Dutch finance minister, who was also a leader in the Troika, commented that the template used for Cyprus, in which depositors' money used to recapitalize, could be used for other members of the European Union if the need for a bailout rises again. Fortunately, This bailout occurred in the third smallest economy in the European Union. The real fear at the end of the day is that if a country with a much larger economy, such as Italy or Spain, which both have GDPs that are exponentially larger than Cyprus, if they were to go through a similar situation, the result would bring on a very long-lasting global recession.